Good afternoon, fellow traders. Welcome to another webinar in the Blue Sky Forex webinar series. Today's topic is Keltner Channels and how they also relate to Bollinger Bands in some way. And of course, we'll go through a few different ways how you can utilize these Keltner Channels. Keltner Channels in general is a relatively an easy topic, and I'm quite sure it's very easy to grasp as well, especially if you have a bit of knowledge about Bollinger Bands already. Okay, now before we continue any further, can you just confirm in the question section whether you can properly hear me and see the first presentation screen, please? Great, thank you very much for the confirmation. So while we are letting the last people connect here, let me just quickly go through the disclaimer. So bear with me for a moment, please. This material is provided as a general marketing communication for information purposes only and does not constitute any independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, taking into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full risk disclosure. So with this out of the way, our agenda today is a quick introduction. We'll go through two market types that you will see during your daily trading activities. Then what are Keltner channels and how do they relate to Bollinger Bands and how they are similar? Then we'll go through a few methods of how to use Keltner channels. We'll briefly discuss stop loss and take profit. And of course, at the end, we'll discuss some dangers when it comes to trading in general. And at the very end, you can ask your questions. So if you have any questions during the webinar, then please do memorize them or write them down and ask at the very end of the webinar. Okay? So I'm one of these senior traders in Blue Sky Forex. We are an educational research and trading group. And we also provide 24-hour trade support and analysis just to help you retail FX traders to make better and safer trading decisions. So the two market types that you will see during your daily trading is first price action, aka a trending market, which is certainly more powerful. You've heard the expression trend is your friend, which rhymes nicely and is also true. Identifying a properly trending market, however, is a bit more difficult because you must have some fundamental knowledge and understanding of what news and events can actually make the underlying asset prices move significantly enough for you to properly benefit from the larger trending move. Okay, so some fundamental understanding is suggested and required to adequately identify a proper trending market. And then we have mean reversion, aka a ranging market, which is more common. It's a bit easier to identify because the price essentially is bouncing between the nearest support and resistance levels and is moving sideways. But certainly this market can also be profitable depending on what approach you use towards trading and what strategy you're using, etc. Okay. Now, Keltner channels themselves, they are said to be or act as a trend following indicator, but I don't completely agree on that because you can also utilize Keltner channels on a ranging market quite successfully if you apply the conditions and you're trading entries and exits correctly. Okay, and it is relatively similar again to Bollinger bonds and how you can utilize them during a ranging and also a trending market. Okay, just as a heads up. So just bringing you out an example of how a ranging and a trending market looks like and how they shift. First of all, on the left side, you have a ranging market. You have then the black lines there where the price is moving between. And the black lines represent the support and resistance levels. The top black line being the resistance and the bottom black line being the support level for the price. And you can see the price is neatly positioned within that price range until it breaks out. So let's pretend there was some kind of event on the underlying asset that made the asset price break out from the range. Okay, as you see on the left side, the big green candle, and then the price started trending. Now, price never moves in a linear or a straight line. It moves in waves. So this is where Elliott wave theory comes into play and is really useful to know and understand and familiarize yourself with it. Although it's not completely necessary for you to completely grasp the concept in order to be a potentially a longer term successful trader. Okay, but again, it's useful to know, so I would highly recommend going through that theory as well. So here we have the first breakout wave, and these are called the impulse waves that are moving along with the newly or generally forming trend. And after you see some exhaustion, for example, there's a doji here, you see the price correcting the previous movement. Okay, and this is the corrective wave which is moving against the uh, generally moving trend. Okay, so the price corrects to a certain percentage. On this occasion, it looks like it is somewhere around 75, which is quite a heavy correction, 75-80%. And then again, we will have another impulse wave starting that goes along with the generally moving trend. So here it goes, it moves in waves until you see some extreme exhaustion, and the price then goes into a ranging mode once again. And you see the price moving within this range between the nearest support and resistance until it breaks out again, etc. So this is how the price moves. Okay. So the Keltner channels, what are they? The Keltner channels are a volatility-based envelope indicator, and they are very similar to Bollinger Bands, especially visually. Okay. Although there is a difference on how the band's distances are calculated. Okay. Now, the distance of the bonds in Keltner channels are calculated based on the average true range ATR in short, and in the center, usually an exponential moving average is used instead of a simple moving average, like in Bollinger Bands. Okay, so Bollinger Bands, the center line is a simple moving average usually, and the bond's distance is based on the standard deviation. While again, in Keltner channels, the middle line is usually an exponential moving average, and the distance of the bonds is based on the average true range. So this is the main difference of Keltner channels and Bollinger Bands. So this difference is not huge, but it has the Keltner channels are thus manifesting onto the chart visually a bit differently as well. And I will show you this very soon as well, so we can compare the Bollinger Bands and Keltner channels side by side. Okay. So the difference is within calculation. So this is the same price activity. And on the upper image, you have the Keltner channels. And on the bottom image, you have the Bollinger bands. Now, you definitely see that there is a difference visually, right? Although, considering the three lines and the general um, overall movement of the channels are rather similar, okay? Now, one big difference between the Kelton channels and the Bollinger Bands is that the Bollinger Bands is more sensitive to volatility and immediate price movements, okay? And thus it is containing the price within its range a bit better than Keltner channels do. However, the Keltner channels themselves, you can see they are more stable and consistent in terms of the bonds width and how the bonds move. Okay, so there is a visual difference, and depending on this visual difference, you might personally later on find perhaps few different conditions where to use either of them. Okay, but now this is something that you should experiment with, see later on whether Keltner channels or Bollinger Bands actually provide you with a bit more accurate or better signals for trading, no matter whether in a trending market or whether in a ranging market. Okay, both of these Bollinger Bands and Keltner channels can be used similarly. There are some Bollinger Band strategies that heavily rely on Bollinger Band formations that we use here in our team. So these same principles and strategies can actually be utilized with Keltner channels as well. So this is something that we will also be going through. And thus, with this in mind, I would highly recommend going into the past webinars on the Hot Forex website and also go through the webinar about these advanced trading strategies that we have and they are utilizing these Bollinger Bands effectively. Okay, so if you log into your HotForex account, go into the education section. There you will find a link that will lead you to the past webinars, and you will find the recording of these webinars there. And you should look out for a webinar called Advanced Trading Strategies. And there you can witness these strategies explained as well. Of course, you'll find other materials there as well, so take your time to go through them all to get as much knowledge as possible. So that's a really great tool that HotForex has provided to you. So how to use these Keltner channels? So there are a few aspects to keep in mind. Keltner channels themselves can really well advise you of potential trend forming. Okay, and this is especially apparent when the consecutive candles start closing outside of the bonds. So that means that the momentum is quite heavily biased on one direction, like on the image that is above the other one. On the upside, you see that on the right side here under my cursor, if you see that, you see the candle started closing outside, and you have many consecutive candles doing the same thing. So already after maybe the fourth or fifth candle that closed outside of the bonds, you might be able to catch a quick upwards scalping trade right here, okay, and reap in some pips of profit, okay, and same applies to downwards. All right, because this is the reason behind this is that Keltner channels, they are relatively stable in terms of its movement, even though it is using the exponential moving average as the center line. Although at the same time, the Bollinger Bands probably you would have seen only a few candles closing outside, and then already the Bollinger Bands would have widened quite heavily just to attempt to contain the immediate price movement here. Okay, but the Keltner channels, they are more stable, thus you witness a lot of candles closing outside of the range, and this is indicating a potential longer term trend forming or a simple short-term momentum in that direction, which you could potentially scalp on. Okay. The next scenario, how you can use the Keltner channels in the same way as Bollinger Bands. And in terms of Bollinger Bands, we are talking about the channel surfer formation. So the channel surfer formation itself is as follows. If you witness a relatively stable movement in one direction, a relatively stable trend in one direction, then in both Keltner channels and Bollinger Bands, when you witness the price moving between the lower part of the bonds, which means between the center moving average and the bottom band in terms of a dropping trend, or between the top band and the middle center moving average in an upwards trend. Okay, but on the image here we have the trend going downwards. So the price is bouncing between the center moving average and the bottom Keltner channel. So what you can do in this scenario is wait until the price retraces back to the center moving average. Then you can initiate your short trade and trade along with the trend. Okay. So in most cases, when the price is coming back to the center moving average, it does bounce back down and continues its previous trending movement, especially here where the bounces are really, really precise at the moving average before it continues its next move downwards. Okay, and with a proper trending movement, you can even utilize this formation several times. So you don't have to enter one trade here at the beginning and hope for the best, but you can do re-entries along with the movement. Okay, you can enter once again here, another entry can be here somewhere, and one more here perhaps, and just trade along with the trend until you see some exhaustion and the price is now again bouncing to the top side of the channel where you can potentially exit your trade or just witness if you see some exhaustion setting in, some indecision in the price, like few small dojis here with larger wicks, and then you can already justify a trade exit. Okay, so exactly the same way like channel surfer formation with Bollinger Bands. And here is a third example how you can utilize the Keltner channels, and this is during a ranging market. On the image at the moment, you witness a sideways moving market, okay? And my recommendation with a sideways moving market would be to raise the ATR value just to push the bonds a bit further away from the moving average in the center, just to widen the range a bit, okay? And in this scenario, if you widen the range a bit, the price reaches those extremities a bit less frequently, and you will be filtering out some potentially bad signals. And while the price is reaching those extremities a bit more rarely, this will help you to get better entries for your scalping trades here, and you can still reap some decent gains. Okay, so for example, if you witness the price reaching to the top extremity like it has done here, you can enter a short trade and perhaps exit at the halfway to the bottom band, or when the price actually reaches the bottom band in a sideways market. Okay, and for example, another example you have here is when the price here again reached the top side, bounced right back down, went to the moving average, but didn't really go past that point. So I would have exited the trade already here when it is going up and down right at the moving average level. Okay, so these small scalping trades can also be conducted on a sideways market while utilizing Keltner channels. Now, please note that if you are utilizing Keltner channels for these quick and fast scalping trades during a sideways market, then you would definitely want to increase the ATR value just to push the bonds a bit further away from the center moving average. Okay. Otherwise, you will or you might witness the price um, reaching the extremities quite frequently, and you might enter some bad and unproductive trades due to that. Okay. So regarding stop loss and take profit. Now, stop loss and take profit levels, first of all, uh, are really reliant on your trading style. If you're scalping, obviously your take profit and stop loss levels will be smaller. Maybe you're just aiming for 15 or 10 or 20 pip gains with a scalping trade. But if you are day trading or position trading, then obviously these stop loss and take profit levels are much further apart. So first of all, generally it depends on your trading style. Um, Another thing it depends on really is your risk reward ratio and the targets that you have set for yourself. Okay. And also depends on how you utilize the Keltner channels. Okay, because for example, if you are utilizing Keltner channels on a trending market, exactly the same way like you're using Bollinger Bands on a trending market and utilizing the channel surfer formation, then your take profit and stop loss levels will also probably be wider than if you are utilizing it during a ranging market that I just showed you the image of. Okay, just scalping during a ranging market depends on the range. However, you can really uh, set your take profit levels to maybe 10-15 pips only. Okay, while utilizing a channel surfer formation with Keltner channels, you may even reach up to 50, 60 pip profits if you utilize the Keltner channels and enter the trades at the right time. The earlier you get onto this type of trade, the better, obviously. But I would first of all definitely still confirm the validity of the formation before initiating any trade at all. Okay. So keep your personal goals in mind. Um, Properly analyze the price behavior, how volatile it is at that moment, what is the time of day, how many markets are currently open, and adjust your stop loss and take profit levels accordingly, because during a more volatile market you might want to set higher stop loss take profit levels, and during a more calmer market where the price movements are much lower, you might want to utilize a bit narrower stop loss and take profit levels. Okay, and when you are position trading, for example, then you can also use trailing stops. Okay, and this meaning when riding bigger trends with Keltner channels, then you can really set these trailing stops. Trailing stops, if you haven't come across this kind of a feature before, is when the MetaTrader 4 instance that you have running on your computer is managing your stop loss level automatically based on the current price movement. So if the price is making higher highs while you are in a buy trade, then the MetaTrader 4 instance will move the stop loss level along with the new higher price levels, and will keep it certain distance, certain set distance that you define yourself away from the new higher price level. Okay, we also have a separate webinar of trading stops, so feel free to check it out in the past webinar section as well. Okay, trailing stops are a really good tool if you are a longer term trader. If you are a scalper, then I would not really uh, recommend to utilize it, because if you're set trading stop values to be really small, then any smaller price fluctuation may trigger a trailing stop, and your stop loss will be pulled relatively close to the current price, and you can really easily be stopped out of your trade. So for scalping, trailing stops are not really a good thing to use. Just wanted to bring that out so you can keep that in mind. So let's talk about a bit determining the risk levels. Before you start trading, before you even enter a trade, you need to determine the risk reward ratios for the whole session. What is your target? And also for the individual trades separately, if you are utilizing different risk reward ratios for different asset pairs, depending on their characteristics, depending on which pairs you have higher probability of success, or which ones you prefer to trade. This is already up to you, but definitely set the risk reward ratio in place before you start trading, and also before you enter the trade. Okay, if you are a beginner or a startup trader, then obviously setting risk reward ratio to 1:1 is completely fine, which means that your take profit and stop loss levels are equal to the distance of your trade entry. So let's say your stop loss is 50 pips, then your take profit is also 50 pips. If you become better and will be an intermediate or an advanced trader already, you can set the risk reward ratio to 1:2, 1:3. And if you become an expert or a professional trader already, you can even ante up your risk reward ratio to 1:4, 1:5. But please keep in mind that you shouldn't really set the risk reward ratio to an unrealistic level, because in this scenario you will probably witness the asset price level never reaching your take profit, and instead at some point it will reverse, and you will either lose some of the profits you have gained depending on when you exit the trade, or you will even hit your stop loss instead, which is not a good outcome. Okay, so don't overdo it, be realistic, and set the risk reward ratio accordingly. Another thing to really specifically keep in mind are actually two rules. The first rule we follow here in our team is that no single trade should be able to cause you more losses than 1% of your total account equity or balance. So keep that in mind. The second rule we follow here is that if you lose 5% of your total account equity or balance in one single trading session, then simply close your tools and walk away, because this way you will be able to live to fight another day, right? As they say. So if you follow these two rules, then you will be able to remain in the industry trading for longer periods of time. And the longer you trade, obviously, the more experience you will get. And the more experience you will get, the better you will become in generating consistent profits over a longer period of time, because that is something that we all want to achieve. Okay? If you are already able to generate consistent profits without large drawdowns over an extensive amount of time, then that is the moment when you can consider whether to take up trading as your main source of income. But when making that decision, you will need to really be critical, because you should only trade with the money that you can afford to lose. And if you don't have these funds available, then you should not be trading at all. Okay? Do not attempt to trade with money that you know that you have to put somewhere else, either on the grocery store for food or any other significant and important place. Okay? Because if you do that, you will really stress yourself out. You cannot focus on trading appropriately and on price chart analysis. You will start making mistakes, and you have really heightened chances of losing these funds that you are utilizing for trading at the moment. If you know you need to put these funds somewhere else, but you just wanted to double up these funds with trading before you actually utilize it somewhere else. So you can maybe end up with some additional cash, right? This doesn't work. This has been tried in the past, it doesn't work, and it will probably end up bad, okay? So definitely don't do it. Another thing we want to bring out is try to refrain from martingale. Martingale is another dangerous tactic that, of course, widely is being used on the market, although you have to be extremely good in trading. You have to be a professional in order to adequately utilize it without extreme high chances of blowing your account. Okay? Martingale is really dangerous. It can really easily empty your account, so try to keep yourself from doing that. Instead of martingaling, you can apply dollar cost averaging. And let me explain what this is. With dollar cost averaging, you don't initiate one single trade like you would as per standard. So, for example, if you are used to initiating only one single trade with lot size of 1 as per standard, then instead of that, you first of all start with a trade with a lot size of 0.3. Now, if that first trade moves against you, let's say that let's 15 pips and the price goes in the other direction, then you initiate your second trade again with a lot size of 0.3. And if you still witness the price moving against you, then you will initiate a third trade with a lot size of 0.4. So now you have 3 trades open instead of 1, but your total lot size is still 1, right? Because you divided the lot size among those 3 trades. So you're still risking the same amount of money, but you have got a better average entry price for this trade sequence. So now if the trade eventually reverses and goes in your desired direction, you will have earned a bit more profits than you would have earned with only a single trade with a lot size of 1. Okay, and the reason is because you got a better average entry price. Okay, please note that all these trades within this $1 cost averaging trading sequence, the stop loss and the take profit levels are the same. Okay, so we are not changing the stop loss and take profit levels for every consecutive trade you initiate within that sequence. Okay, and on the contrary, if the price still goes against your desired direction and hits your stop loss level, then you will have lost a bit less money with your last trade in the sequence than you've lost with the first trade in the sequence. And ultimately, as again you got a better average entry price, you will have lost a bit less money. And this in longer term will really be beneficial for you because you have earned a bit more money or lost a bit less money. Okay, so definitely something to try to utilize, but only if your initial trade accuracy is not very high. If your initial trade accuracy is around 50% or so, then dollar cost averaging can really benefit your ultimate gains. If your initial trade accuracy is around 65% or higher, then dollar cost averaging will probably not be beneficial for you because you will ultimately earn a bit more money when initiating a single one lot trade and winning it than initiating a 0.3 lot trade and winning it. Okay, that makes sense, right? So dollar cost averaging, a good thing to have in your arsenal, but you have to determine your initial trade accuracy before you utilize it. Okay. And now dangers when it comes to trading. So a few points I want to make. First of all, try to refrain from using any automated systems or bots or robots when trading. Most of them are designed to generate losses on your trading account. So please be extremely careful. When you want to test any of these out, please do so on a demo account. And if you witness your account balance increasing over a longer period of time without large drawdowns, then you can only decide whether you want to set it up on a live account or not. And if you do so, please use very low lot sizes to trade as safely as possible. Okay. Next thing I want to bring out is news. And we're talking about high impact news in this scenario. It is, especially for beginners, it is recommended that you stay out of the market 15 to 30 minutes prior to the news event and 15 to 30 minutes after the news event until the news numbers are digested by the market participants and the price starts moving in certain direction based on the numbers. Okay, if you want to try to trade the news, then you would need to focus on trading the news specifically. And this is already a completely other topic where you have to plan your trading month ahead. The news calendars are already provided to you a month ahead, so you know what events are happening. and you will then be able to plan what news you want to trade. Okay, so stay away from news if possible. And another thing to point out here, and that is a bit more related to the Keltner Channels indicator as well, is that if you really define a very low indicator period or any value in the indicator, which makes it more sensitive to the current price movements, then you are heading in for a lot of false signals. Okay, so the lower the periods of the indicator, the more noise you are incorporating um, into the indicators, and thus you will get more false signals. Okay, so that is definitely something to also keep in mind. So this was it, a very brief and basic introduction to Keltner channels. There is really not much more to it. Keltner channels, they are a very easy indicator, also very useful, but there is not much point to try to utilize Bollinger Bands or Keltner channels at the same time, because they are providing you with very similar information. And if you add both of them, you are just cluttering up your workspace. So either pick one of these two, either Bollinger Bands or Keltner channels, find out which one works best for you, for your personal trading habits and tactics and strategies. So yeah, go ahead, experiment, test them out, and find which one works best for you. So I'll be taking questions now, and I'm opening up the question section, so bear with me for a moment. Okay, Chi Lee is asking, can we enter from the midline, essentially the moving average, or we can only enter from the top and the bottom band? Okay, it's a good question, but this now depends on what market type you're trading in and how you're applying the Keltner channels. So based on the examples that I brought before, for example, during a ranging market that you see on this slide, if the market is moving sideways, then you will, in most cases, witness the price bouncing between the top and the bottom band. Okay, it might have some consolidations at the moving average in the center as well from time to time, but in most cases you will still see the price moving to the top side of the extremity of the range and then to the bottom side of the range. So going short from the top side and going long from the bottom side would be a valid tactic during a sideways market using Keltner channels. However, if you really see that um, an upcoming approach of the price towards the moving average in the center will have high chances of bouncing off from there and continuing again to the upside if it came from the upside already, then sure, feel free to enter the trade at the moving average as well, although I would still keep it to the top band and the bottom band. Okay. And for a channel surfer formation, this originally you would be entering the trade at the moving average in the center and then trading along with the trend. Uh, please note that in some cases, like here, you may witness the price going almost back to the top side while we are still observing a trend downwards. Definitely this can be another potential entry point for you, although I would be careful because you might actually be witnessing an exhaustion of the price, an exhaustion of the trend. Okay, and either a short to medium term pullback retracement or a full-blown reversal of that trend. Okay, so when you are entering at the top side here, then be ready for a potential reversal upcoming as well. But it all depends on the asset, the time you're trading it at, also the recent price behavior that you would need to analyze on the run, and all these kind of bits and pieces. Danilo is asking, what indicator will work best with Keltner channels aside from an exponential moving average? Okay, one thing to mention that Keltner channels already are incorporating an exponential moving average in the as the center line, so you don't need to set up another exponential moving average onto the chart unless it has a completely different period than the Keltner channels exponential moving average has. And in terms of the other technical indicators that might work good with Keltner channels, you can utilize the same technical indicators that you may utilize with Bollinger Bands. And these indicators include some overbought oversold indicators like RSI and the stochastics during a ranging market especially. So for example, if the price reaches the uh, upside extremity and you also witness on the RSI or the stochastics that the price is in the overbought area, then you have just an additional confirmation that the price has higher probability of bouncing off from the top side and chasing the bottom band now. Okay, Ahmed is asking, what is the setting for the upper band and the bottom band? Well, I would like to assure you that the default settings for the Kelvin channels that you have in MetaTrader 4 is a good point to start with, okay? And if you witness the channel being a bit too narrow for you, you witness the price really often going outside of the range of the Kelvin channels, and you have difficulties finding good trade entries, then you should adjust the ATR values of the Keltner channels. For example, set it to higher if you often witness the price going outside. But it, ultimately still depends on your own personal preference and the strategy that you are using. Okay, Chi Lee is also asking for trending market, um, do we enter the market, do we enter the trade when the price is outside of the bonds? How many candlesticks outside it should be when we should consider it trending? Okay, so going back to the example that we have on this slide, the picture at the top, where the price simply breaks out of the range of the Kelvin channels, right? Um, in Kelvin channels, you will let's take this example. It's a bit better, so I can also compare it to the Bollinger Bands. Um, Explaining again, the Kelvin channels are a bit less sensitive to the immediate price movements, where the Bollinger Bands attempt to constrain the price a bit better. Okay, you see the Bollinger Bands quickly widening when the breakout is happening, while the Kelvin channels have been relatively stable throughout the consolidation at this point here. And when the breakout is happening, you will still see Keltner channels being relatively stable, and you have a lot of consecutive candles closing outside of the bonds. Now, I would say that during a breakout, for example, you can wait for 4 or 5 candles to close outside completely, and then take a short-term scalping trade along with the direction of the breakout. Okay, this is something you can definitely do. So we have another, so this should be the same price activity. Yes, it is the same price activity. So that's the same thing that is happening here. Closing outside of the bonds, consecutive candles, 4 or 5 candles, and you can scalp the trade from here. Okay. If it is a stably trending market, then you will relatively often not even see it closing outside of the bonds, but you will witness something that you see on the image below here. And it actually is moving between the lower band and the moving average in the center, while moving along with the direction of the trend. Okay. Okay, Danilo is asking a bit of an off-topic question, but what time frame is recommended to use when you are scalping, 15 minutes or 1 hour? Okay, I'm going to just tell you from my own personal trading experience and perspective. I love 1 hour charts. This is my bread and butter. I do most of my chart analysis on 1 hour charts. Sometimes I go a bit higher to 4 hour, 8 hour charts, or maybe in daily charts to take a look at the general market condition and the general trend. And sometimes I even zoom into 15-minute and 5-minute chart to pinpoint my trade entry accurately. Okay. Now, if you are scalping, and if you are scalping only, and if your intention is to scalp for 5, 10, 15, 20 pips of profit per trade, and then you can definitely go down to 15-minute chart, maybe even 5-minute charts if your um, targets are around 10, 15 pips. Okay, 5-minute charts work for that as well, but please note that you will definitely witness a lot more false signals in that case. 15 minutes is relatively good middle ground between 5-minute and 1 hour charts for scalping indeed. So, but ultimately you will still need to find out which time frame suits you the best, where you have higher success rate. Ugochukwu is asking, what is divergence trading, as it was mentioned in dollar cost averaging? I don't think I mentioned anything about divergence when explaining dollar cost averaging. However, divergences between technical indicators like overbought oversold indicators like RSI and stochastics and the price is, to my personal experience, a quite reliable indicator of an upcoming reversal. Okay, so if you see the price generating higher highs when it's climbing, for example, but on the RSI you see lower highs being generated, meaning that the value of the indicator will not go uh, even higher anymore, but it will generate, yes, these kind of spiky tops, but these spiky tops are lower than the previous ones. Just trying to explain you visually here, right? Then you have a divergence between the indicator and the price, and these divergences, to my experience, are relatively reliable indicators of a potential upcoming reversal. Yes. Okay, another question. Where do we find the Keltner channel on MetaTrader desktop platform? MetaTrader 4, I presume you're talking about. And Keltner channels, I should be one of these indicators that is not available by default on the MetaTrader 4. Okay, so you might want to look for these custom-made Keltner channels indicators online and then install it to the MetaTrader 4, which is a fairly easy and simple procedure anyway, so I'm quite sure you will manage. I have the Keltner channels already downloaded onto my MetaTrader 4 platform, so I have it already available, but you should then look online. And the official MetaQuotes websites should also have this quite widely used indicator available free of charge. Okay, and we are closing up to the 1 hour mark. So are there any more questions coming in? I see one more question from Ukachukwu. Uh, Position trading, is it the same with swing trading? No, actually, position trading and swing trading are different in terms of the time frame that these trades last. So swing trading usually is a shorter term trading style versus position trading, of course, when the positions usually last for some days because you're essentially just riding the swing, right? Trading with a swing. But position trading is involves you entering a trade for a longer periods of time, usually at least a few weeks. And while you're, for example, trying to hold a potentially well-performing stock, right? You're still waiting for it to climb, the stock price to increase, and that you can remain in the trade for weeks and even months, right? But swing trading is just you trust riding the next price swing before the correction. And Chile is also asking trending. Can we also enter at breakout? See what do you mean by this? Can you elaborate a bit more on that question? Sorry, I didn't quite catch it. Okay, so you mean entering the trade after the breakout? Is that what you mean? Breakout from the top. Yeah, okay, of course. This is how you would trade breakouts in general. Anyways, you will wait until the price closes outside or the price range that is formed by Keltner channels or Bollinger bands. In Keltner channels, it's more apparent the candles closing outside of the bonds, and as mentioned previously on this webinar, if you already witnessed, let's say, 4 or 5 candles completely closing outside of the bonds, then you can surely think about getting into a scalping trade. But breakouts usually don't last forever, right? Breakouts are relatively immediate that can result in stable forming trends over longer periods of time, depending on what actually caused the breakout. If it was a significant and really fundamental news that caused a breakout, then surely this breakout can form into a longer period trend, but then you will see that the bonds are already adjusting to the movement of the price, and it still attempts to contain it even though it is heavily trending in one direction. Okay. Okay, and you want to know if you can enter immediately from the first breakout candle. I would not do that with Keltner channels, at least, because Keltner channels, you will witness that the breakouts are more, they happen a bit easier because the Kelton channels, they're not so sensitive to the immediate price movements, right? So you might have like these occasional quick price fluctuations outside of the bond and then they come back inside, right? So if you already entered from the first candle that closed outside of the bonds, then you can end up simply losing the trade when it quickly drops again. Okay, and now we're 3 minutes past the 1 hour mark. If there are any questions that remain unanswered, then please do not hesitate to send an email to webinars@hotforex.com. They will be more than happy to answer your questions here as well. And from my side, as always, thank you very much for attending this webinar. It has been my pleasure to be the host, and trade as safely as possible. Stay safe and good luck. Take care.